In this video, we're going to walk through Handout 8-2, the estimating and recording of uncollectible accounts using the percentage of credit sales method. We're told that in 2020, Vandelay reported $300,000 in sales, and the company's allowance for doubtful accounts has a credit balance of $1,000. So again, before we make any adjustments, our allowance for doubtful accounts has a $100,000 credit balance. We're also told that based on prior experience, management estimates that 2% of sales will result in bad debts. And we're then asked to prepare our required adjusting journal entries. So we take the $300,000 and we multiply it by 2%. That gives us $6,000 for our estimated bad debt expense for the year. So we're going to debit bad debt expense for $6,000, which of course will decrease stockholders' equity. And we need to credit, again, the allowance for doubtful accounts. We don't have a particular receivable that we know is going bad. It's just that based on past experience, 2% of them go bad. So we want to match the cost of that bad debt that's going to happen in a future period with current period sales. And we do that with our allowance for doubtful accounts. And you can notice that in the percentage of sales method, we don't pay attention to the current balance in the allowance for doubtful accounts. But once we make that entry, our allowance goes up by $6,000 and our ending balance in the allowance is $7,000. Let's consider another scenario. In the second scenario, we have the same $300,000 in sales, but this time the company has a $600 debit balance in the allowance for doubtful accounts. Again, what do? We have got same 2% estimate of sales will be resulting in bad debt. So we take the $300,000 in credit sales, multiply it by 2% to get $6,000 for our estimated bad debt expense. We debit bad debt expense for $6,000, and of course we credit the allowance for doubtful accounts for $6,000. Once we post this to the T account, that gives us an ending balance in the allowance for doubtful accounts of $5,400. We aren't too concerned with this ending balance being different between these two methods. Ideally, our estimates will even out in the long run because some years it might be 1.7%, other years 2.3%, but on average, we've estimated that bad debt will be 2% of sales. And with the percentage of sales method, we do not pay attention to what's going on the balance sheet. Our estimate is based solely on sales. Of course, if over time our allowance for doubtful accounts ended up with a huge debit balance, that would mean that we're not setting aside enough. On the other hand, if we end up with a huge credit balance over time, that means that we're setting aside too much. And in either case, we might want to revise our estimate for bad debt expense.